All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. This session is so important to me. I'm even doing it while Olivia and I are out on a trip, hence the different background today. So thank you for allowing me to do this.
I love it, man. So this is for June the 9th. Thank you for all that you do for the channel, for everybody out there. So many of my friends say that, hey, like they depend on and look forward to hearing what's going on in such a quick little 8 to 12, 15-minute little digest. So let's get right into it. Again, the summer's not disappointing. Let's talk about recession. Your thoughts, recession call. What's going on there?
Yeah. So one of the things that I did, and I like to own things when the data goes the other way, I called for a recession starting April 1st, really around April 12th when Silicon Valley Bank went out. I saw the consumer get scared. I saw behavior change. And I went out really early and said, I think the US will be in a recession starting Q2. Now, it is too early to say I'm officially wrong, but I will admit, as we get into the middle of June, it's not looking good, right? Jobs are still relatively strong. GDP is estimated to be 2%. There's a lot of data going against me. I'm going to own that if I'm wrong, but I will say I was convinced, right, that was like we were heading there. And today I'm not nearly as convinced, but I will happily own that. Not that a recession will be avoided. Recessions are natural parts of the business cycle. It just is looking like my call was early. And when I'm right, I celebrate. And when I'm probably wrong, I want to acknowledge those too. So I wanted to bring that to you folks, that I think my recession call, while not officially wrong yet, is it's not looking good. It's not looking good.
Okay. Very interesting. I'm going to come back to it too, and we'll tie it all together at the very end. Where are we at? What does this really mean? And especially for our one rental at a time community, realtors, investors, we'll tie it all together at the very end. So stay to the very end. Let's keep going. Let's talk about jobless claims this week. What did you see?
Yeah, so jobless claims, I keep reminding people, this is like the one drumbeat we get every Thursday morning, I think 5:30 a.m. Pacific. It is probably the best leading indicator about the job market. And we all know the job market is one of the lagging indicator. It's one of the strongest it's been. But we get this report every Thursday. And for the first time, we got a number that surprised meaningfully to the upside and broke above 250, right? We haven't been above 250 weekly claims in quite a while. So I think it came in at like 262 or 266, which was A, meaningfully higher than last week, B, meaningfully higher than expectations. I have often said on this series that I think Jerome Powell wants to see that number over 300,000. And at least for the first part of Q2, it's been under 230 for the most part, or 240. So again, back to point one, I might be early on my recession call. One data point is not a trend. But this is something you and I will be talking about probably for the next 2 or 3 weeks to see if there's follow through. Was it a blip because of a holiday weekend? Is this more signs that the unemployment rate, which bottomed at 3.4, currently sits at 3.7, is going higher as the U6, the uninterested, become U3, the interested unemployed? And that's an economic term we can go into if we want, but there's more people looking for work, hence are going on claims. So yeah, it's this Thursday number probably made Jerome Powell smile, because I think he's winning on many, many different fronts. And this number probably heading in the right direction for him.
Very interesting. Very interesting. You think 300,000 is the number that kind of
that's what he probably wants to see to go on pause for an extended period of time.
Got it. And it feels like the trend is headed that way.
I think clear as day, the trend is going that way. Yes.
Okay. All right. Well, let's continue. And I'm going to come back to that also. I'll talk about the Fed a little bit, talk about rates, the Fed rate. Let's transition the 30-year mortgage rate. What did you see this week? I know last week we had a wild ride. The whole month of May was kind of really interesting. What did you see this week with 30-year mortgages?
Yeah, and I'm so happy to do this with you every week because it allows me to encompass what's going on. So about 2 weeks ago, I warned people that rates were going higher. This was still the debt ceiling. This was a tough talking Fed. I said, guys, rates are going higher, right? They just are. And oh, by the way, they did. And then I said, don't worry, because what's going to happen is right after that, we're going to have kind of 2, 3, 4 months of generally better news. So A, we got the debt ceiling resolved. Cool. B, as I just shared earlier, the weekly unemployment claims seem to be heading in the right direction. C, GDP now and true-flation are showing inflation rolling over. And the big one, we'll talk about this again later, we're going to get a CPI print on Tuesday, and that might be the watershed moment where rates start coming down. So again, I think we have seen the peak in 30-year mortgage for 2023. I am not calling for a crash. I'm not calling for 5%. I'm just saying we've seen the cycle peak and we trend lower from here is my call.
I love it. I love it. Spot on. And again, very consistent. And of course, as things change, you, of course, hey, let's adapt, let's pivot, let's redirect, just like your recession call, how we started off. So I love it. I love it. Let's talk about CPI next week. What do you think is going to happen with CPI? Where are we at there?
Yeah, so we're talking CPI headline, obviously CPI core. Both of those will be printed year on year, month on month. But let's be clear. The media is going to focus on CPI headline, the yearly number. We have had 10 months of falling CPI, peaked at 9.1, last read was 4.9. We can go into all the reasons why, but I think we're going to get a number below 4.3 or better. And that's going to be a large drop over, 60 basis points. And I think that's just going to be another sign that rates can come down. It will be a sign because, again, CPI comes out Tuesday. The Fed decides Wednesday. Next week's a big deal. I think CPI comes in at 4.3 or better. There's absolutely no chance we get a Fed rate increase. I actually think today, and I've called for weeks, there's no chance. But if CPI surprised higher or was 4.8 or 4.7, not meaningfully down from 4.9, you could convince me that one more rate hike is a good thing. I don't think it's coming. I think people will be shocked. Oh my God, CPI's been cut in half. Went from 9.1 to 4.3 or 4.2. The Fed is winning. The Fed's doing this and that. And then mortgage rates compress because right now we're sitting at 320 basis points where average is 180 basis points. And, we start talking about, low sixes, sooner rather than later on mortgage rates.
Very interesting. So next week, huge week, right? Tuesday,
huge.
That CPI number is huge for the Fed. And what happens with the Fed on Wednesday? Is that?
Oh, huge week, huge day.
Okay. So for our Friday financial news watchers, I would encourage you. I think you watch the daily financial news on YouTube with Michael next week, both Tuesday and Wednesday. If you're really into this conversation, I watch the financial daily news every day. So thank you, Michael, for that.
Thank you.
Man, big week next week. Let's see. We definitely need stable rates for sure. That's one thing we need for certainty in the market. Would you agree?
Oh, the Fed being done, it's called the terminal rate, is a good thing.
Yep.
And Tuesday could be the day that we all know that we're there. It really could be that watershed moment.
I love it. The official watershed moment we will be watching next week. So we're going to connect the dots on all of this, but let's go to our next talk track, which is real estate billionaires. What did you see this week and your thoughts?
Yeah. So, on my channel, I think 6 months ago, we were making fun of Barry Sternlicht. We were calling him Billionaire Barry because he was coming on CNBC with PowerPoint talking about the Fed should cut and this, that. Basically, real estate billionaires are usually illiquid. And if they're in the commercial market, which let's be clear, you're going to be a billionaire when you're in the commercial market, you're in some pain because your debt structure and all of that. I want to go to multifamily and social media. There are social media types who have been pushing multifamily, Class A, who are billionaires, at least by social media standards. And I had an interview with one of my syndicators on Thursday, Jonathan Twomley, where we pulled up an Excel spreadsheet and we created a billionaire at yesterday's cap rates. And all we did is we changed slightly the cap rate and slightly the NOI. And we watched a billionaire go to zero. We changed the cap rate a little bit more, and they went to a negative $1 billion. So, folks, there are billionaires who got to be billionaires buying cap rates at 3.5% or 4%, and are celebrated for having thousands of units. I'm here to tell you, based on that very simple change in cap rate and NOI, that not only are they not billionaires today, there's a very good chance they have negative net worths. Now, let's be clear. A negative net worth doesn't mean squat, because as long as you can hold the asset and wait for it to return, you're going to be okay. Yep. But I want you to realize, celebrating buying things at historically low cap rates, like 3.5%, watching those explode to only 5%, you can watch $1 billion go away in a heartbeat. So that's why I think 30-year fixed rate, boring residential properties is a great thing. How many social media types want to tell you bigger is better? It's not true. Bigger is not always better. And you are about to see a lot of people who push bigger is better get hurt. And some of them are going to come back and talk about residential because of 30-year fixed rate money. It's just coming, and I can predict the future.
Very interesting. And I think too, it's important, even from a simplistic standpoint. Let me just see if I've got this idea right with the billionaire. In most cases, when you see these big apartment building commercial buyers, operators, we'll call them, they're typically running as the general partner. They then have limited partners who actually put up most and or all of the equity, all the cash to get in the deal, usually 30 or 40%. Is that accurate so far?
Yeah, it's certainly 30%. Yep.
Yep. And in most cases, the operator, the guy that's the quote unquote billionaire, is usually, because he, as the managing general partner, they own a sliver of that transaction. They own 10%, 12%, 8%, 5%, something along, maybe 15%, something like that, as a managing general partner. Is that accurate?
Yeah, I mean, all deal structures are different, but let's just say they don't have a lot of skin in the game. Yes.
Yep. And because with that adjusted cap rate, a cap rate going from 3.5% to 5% as an example, that just that slight shift in margin is enough to gobble up their managing general partner portion of it, as well as probably some of the private equity and the limited partners equity. Is that?
It's worse than that. In the example that I ran through, I'll go from memory here because it was Thursday. We took a billionaire who had roughly, I think it was $40 billion in values. Yep. We assumed that they put up all of the equity. Yep. We assumed that they put in 25% of the equity. So we didn't even add the risk of LPs. We're like, hey, you're a billionaire. You had, all this money, you dumped it into real estate, and now you're a billionaire with no partners. Then we took the cap rate from 3.5 to 4. We took the NOI down 15% or 12%. They went from being worth 1.2 billion to 0. We took it from 4 cap to a 5 cap. They had a negative net worth of $1.2 billion.
Yep.
Now, if you add what you added, if you're an LP, you should be frightened, because that general partner can walk away generally unscathed and you lose $1 billion. Yep. Not good. Not good, man. Not good.
Very interesting times. And with regard to commercial fallout, I know we've said this, we've compared it to like the baseball game. And you said before that they haven't even started. They're still chalking the field. They haven't even sang the national anthem. What are your thoughts today? Where are we at in this whole commercial meltdown?
We might be, the first batter might be up, but we haven't had the first pitch. The pain is clear. I am hearing from lenders around me that people are quietly foreclosing because they don't want to make a big splash.
Yep.
So I think the game has officially started, but the pitcher is still yet to throw the first pitch.
Got it. It's so early.
So early.
Got it. Okay. All right. So now let's go back, and we're going to pull this all together. So we talked about jobless claims. We talked about the 30-year mortgage. We talked about CPI next week, how critical that is, that next week we believe that we'll be at a terminal rate, and then an official pause where we'll start to see margin compress on 30-year mortgages. We'll start to see the rates begin to soften into the summer. Let's go back to the recession. When was the last time we had a recession? Was it 2008?
Well, we technically had a very short recession right after the pandemic started, but yeah, it would be, I think the last official recession was 2008. Yeah. I mean, the long recession.
And a recession usually every 10 years plus or minus. Yeah, or what are your thoughts there?
8 to 10 is historical average. We currently are in the longest bull run on record if we X the pandemic recession. So okay. Yeah, we're long in the tooth.
Got it. And so we may not be in a recession. You're saying, okay, you might have been a little early on that. Do you still believe that we hit a recession in 2023 and or even early 24, mid 24 next year?
Again, my call, for whatever it's worth, I think it will it will start in 2023.
Got it.
Sometime. Yeah.
Got it. And it's just a matter of, okay, let's just see how the chips fall. There's still a lot of money circulating. There are people still pumping. The numbers, reports are all still favorable. We just haven't quite hit that, but it seems as though the trend is that we are headed that way for sure.
Certainly feels that way to me. Correct. Well said, by the way. Yes.
Okay. All right. So with that said, let's talk about opportunity. So the one rental at a time investor, the one rental at a time realtor, people that are out there that their livelihood and or their investment portfolio is about what we talk about every week. Just your thoughts on opportunity and how do we keep our mindset sharp and looking for opportunities? Your kind of closing thoughts here.
So I'm so happy for the one rental at a time community and your community and Squad Up and all of that, because I think what we're about to uncover over the next 9 to 12 months as billionaires go bust is the power of the 30-year mortgage. The residential 30-year mortgage is a unique attribute of the U.S. housing market. And if you can get a deal that cash flows day one with 30-year fixed rate mortgage, which you can do today, it just takes work. It's hard. You're going to be doing really, really well, because you can't lose the asset if it cash flows day one and with 30-year fixed rate money. And the billionaires are going to lose theirs, or very likely to lose some at least, because the debt resets. Second, I had a conversation with Velocity Mortgage again on Thursday, who gave me 30-year money on apartments. I said in that video, and I'll say again here, I am greedily shopping for 5 to 40 units. Again, we're early, right? We talked about the first pitch is yet to be thrown. But any commercial deal I get done won't be with a 5-year or 7-year. I will get it done with a Velocity Mortgage 30-year fixed rate loan. Even if the rate's 8%, it will cash flow day one. I will lock in my term. I won't have interest rate risk. So I can only tell people I'm encouraged by what I see coming. And you should be, I mean, this is what we want. And I'm excited.
Yeah. And I would echo that. Even, looking at that same deal that you just mentioned, even with seller financing.
Yeah, exactly.
Yeah.
Seller financing, I mean, all the stuff that you teach and you're so much better at than me. You got to put on another event, because we've got to get more people. I've got to go to it. I got to sit in the audience because you have so much to offer. You've been through this before. Dude, I'm going to push you to schedule something, in the next couple of months. Let's go.
Yeah, I'm excited. I'm excited for what we're doing and where we're at. And I love, obviously, our collaboration, obviously. And again, even after we get done with this Zoom, we're going to talk about the expansion in Fresno, California. We want to be, Michael's already there. I've dipped my toe in there, but we're looking for how do we maximize the opportunity with the one rental at a time community. Also in terms of how do we expand our footprint, Michael's footprint, opportunities for everybody in the Fresno, the Central Valley market. So Michael, thank you so much for all that you do. Folks, if you have any interest, and I've said this several times, he and I are going to have a meeting after this. We hit pause on the recorder, and then he and I are going to have about a 15-20 minute meeting where I'm going to twist his arm and tell him he needs to increase the price of the course. So if you have any interest in buying the course, you better buy it sooner than later, because the price will be going up. So where can they find the course, Michael?
You go to onerentalatatime.com. I just launched a brand new website, so let me know what you think. And really why I created a new website and spent more money than I could imagine is I wanted to celebrate the millionaires that contribute. So Ty, thank you for being a millionaire that contributes on my channel. And you are featured, Omar, Adrian, all the millionaires are there. Go see what they do. Go. You know what I think the millionaires did great is they all recommended books that were important to them. So thank you for that.
I love it. Thank you, Michael. Have a great weekend. Thank you all for watching.